It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian equities surge with Hong Kong and mainland China extending the gains sparked by Beijing's fresh support measures. As Chinese stocks find their mojo, Indian equities are losing their shine with buy calls slowly vanishing due to valuations. And with trade tensions simmering between the EU and China, the executive director of the EU-ASEAN Business Council will be joining us to explain how Southeast Asia provides an opportunity. Now, talk about finding mojo. Asian stocks up for a fifth day. That's on the back of that slew of measures from China to support its economy as well as the property sector. Take a look where we are in terms of the CSI 300 index up by 2.7%. Hang Seng up by 1.8% right now. Of course, we had the PBOC cutting its one-year MLF to 2% from 2.3%. The question being asked right now is whether that rally is sustainable. We're seeing monetary easing, but fiscal policy perhaps needs to come in play as well. At this point in time, though, Asian stocks getting a boost from China. Of course, overnight we had the U.S. posting yet another record high. Speaking of China, the yuan in focus, breaching that 7 psychological level. Where will it go from here? And how much tolerance does the PBOC have when it comes to a stronger currency? Let's get more on markets with Bloomberg M Live strategist Mary Nicola and our first guest, Eugenia Victorino, head of Asia strategy at SEB. Mary, so is this sustainable? People say, you know what? Short term, yes. Longer term, something else needs to be done.
So I think the best way to put it is that it provides a boost for equities, but it doesn't fix the underlying structural problems in the economy. But at least you see a sense of urgency from policymakers to do something. They're putting a floor under equities. They're announcing that equity stabilization fund, which was a huge deal. I think the fact that there was some policy rate cuts coming through, that was already priced in, but it was more really about that equity stabilization fund that's trying to put a floor under equities, and I think a lot of investors are going to appreciate that.
A sense of urgency, a step in the right direction, but still not enough.
Indeed, because at the end of the day, you still have to make sure that the domestic demand really picks up. And what is interesting here is that before this policy announcements, we've been seeing that local governments are actually underspending their budget. So at this point, I'm not even waiting for a new fiscal package. What I want is a faster implementation. But then, we can talk about the structural issues and then fading this bounce. But that's not going to happen today because right now we're still on that sugar rush and we still have maybe at least 5% upside to the equities anyway.
But it does feel like it is enough to dip your toes in the Chinese market.
Well, considering that the foreign investors have been so underweight for more than a year now, it wouldn't take much for them to dip their toes. But at the end of the day, they wouldn't necessarily go all in on the index, but really focus on the sectors that there is actually more room for earnings to come in. Because, definitely the PBOC is providing liquidity to buy the stocks, but you have to have the earnings growth to be strategically positive on the Chinese equities.
And where will you find the earnings growth, Mary? Which are the sectors that are worth considering?
We've seen the earnings growth actually do okay for China in the last quarter. And obviously they have, done a lot in terms of cost cutting and things like that. But at the end of the day, they all implied weaker outlooks because of the weakness in domestic demand. And there's still, as Eugenia mentioned, you still need to bring that up and boost the domestic demand. So a lot of the times you will find people more of like bargain shoppers, right? Looking for where the opportunities are and what's cheap, because at the end of the day, it is quite cheap. And if you've been so under-owned for such a long time, you might start saying, oh, maybe I'll take a look at this or have a little bit of this as well.
We talk about how the PBOC is now sending a message that it is seriously in a state of urgency. What would be the PBOC's next move, you think?
Well, they've already communicated that they're willing to cut another time before the end of the year. So they haven't even cut. They're already promising another cut. So Like, how much more support can they possibly give, right?
Verbal support is free.
Exactly. And then now they've also raised their participation on the relending program on the property sector. Definitely that's going to put some a positive spin on the confidence. But as I said, unless the households really see that these outstanding projects are moving, they're not likely to go to their real estate managers and start looking for a property. They just want to get the keys to the properties that they already bought.
So a question for you, Eugenia, in terms of we're always talking about fiscal policy and what we want to see. You've mentioned that the local governments have the money, but they're not being deployed. So what do we need to see on the fiscal policy side in terms of the fact that, you know, we don't want to see more bridges to nowhere, more buildings, more infrastructure, right? That seems to be, doesn't have the same sort of fiscal impulse or growth impulse that we used to. So what is it? What's the right recipe?
So to be fair, actually, it's actually the central government's efforts to rein in on like the discipline on the local governments. But at the same time, local government officials are a bit afraid to be under the scope of the corruption investigation, and nobody wants to make a decision. I was just in China at the beginning of September, and they were already saying, or like our clients were already saying, that the infrastructure spending is really quite slow, and most of the infrastructure prioritized by the local governments are those that are more likely to be profitable. And from that sense, it's very difficult to see a real boost to the infrastructure spending. But we don't want a big boost. We just want them to spend according to what has already been budgeted.
Eugenia, we always talk about China in relation to India. We're seeing some sell-off in the Indian market, and some say it's perhaps valuations. Is there an argument to be had where perhaps a rotation might be coming, given that there's now some interest in China? Take your money out of India, put it into China. Might that happen?
Well, if you're only looking from the foreign investors' perspective, that might be true, but then we're not talking about the domestic participation rate. And there's a lot of automatic allocation that is already happening from the domestic point of view, and that would really drive the continued gains in the Indian equities. Moreover, if you're looking at it from an emerging markets perspective, I don't think there's any other country that actually delivers on the equity earnings that is at par on the nominal growth. And if you look at it, China, at this point, it's very difficult to see nominal growth unless you have inflation coming in. Meanwhile, inflation in India is okay.
I'm going to ask you the MLive question of the day, and I'm sensing I already know the answer. I'll ask you anyway. The question is, will China stocks perform best by year-end?
Well, right now, the Shanghai Composite is not even positive on a year-to-date basis. Just from the EM Asia perspective, it's very difficult to get ahead of Taiwan, and Taiwan is already above 25%. India is almost 20%. There's a lot of catch-up to happen for China to be the best performer in the region. So I don't think it's going to be happening this year.
So Eugenia, a follow-up to that, what do you think could be the best performer into year-end from Asia?
Well, I would still be quite positive on the Indian equities because, as I said, there's nominal growth and they're delivering on the equity earnings there. There's domestic participation, but at the same time, foreign participation is also quite strong. And with liquidity conditions improving with the Fed cutting, then there's even more room for foreigners to go more into Indian equities.
I want to go into currencies. The yuan breaching 7, the psychological level. How much appetite does the PBOC have with the yuan at this level?
Well, because you see, the PBOC is really looking at the yuan from a basket perspective, and from the renminbi, the trade-weighted renminbi index. Actually, from July until the most recent data, the trend is still going down. Obviously, from what happened yesterday, there was an increase in the trade-weighted renminbi index, but we're far from the threshold where the PBOC would actually put on the warning signals. Having said that, the corporates are now likely pushing the panic button and converting their dollar earnings. We've seen an improvement in the FX settlements data showing that corporates have indeed increased the conversion. And with dollar CNH going below 7, I'm sure they're in a panic right now.
Yuan, the tolerance for below 7?
I think we've seen consistently from their fixings that they don't have the tolerance for below 7 at this point in time. I think it's still, even if they're looking at it from a trade-weighted perspective, that dollar CNY level is still a key psychological level that they look at and that everyone focuses on. So they're still going to be a little bit cautious. We saw from the PBOC governor that they don't want it to be a one-way bet, and so they're going to have to mitigate that. But I think one of the key things here is that the stability of the yuan overall is actually a really good positive for Asian currencies. So whether it continues to appreciate or not, but even if it's just stable, it's still good for this region's currencies.
So stability for Asian currencies, which ones in particular are you looking at?
So I would say, like, if you do a sensitivity analysis of which currencies are the most sensitive to the CNY, Thai baht and Malaysian ringgit come up as the top 2. That shouldn't be a surprise because we've seen them rally so strongly in the past few months. So I think those 2 will continue. Korea is not far behind as well. So those 3 currencies, and then, for example, Korea has been lagging behind, so there's plenty of room to catch up for the won.
And so it is a good space to be in, Asian currencies, especially on the back of expectations the Fed may cut further.
Well, definitely. So, like, if
what are your favorite crosses?
Well, as Mary has already mentioned, the Korean
crosses.
The Korean won is really lagging behind. But actually, this year, my main call is really to go long on the Aussie because, first of all, the Aussie is a risk-sensitive currency. So just because you have a positive risk sentiment, the Aussie is likely to continue to remain resilient. And then the RBA is definitely not being pressured to cut, or they're resisting the easing impulse from the other central banks. So the monetary policy divergence is a positive. And then now you have China coming in. Obviously now, like 69 or even higher in the near term is actually quite positive for the Aussie. If you look at it on the cross, I would prefer to go Aussie Kiwi.
The thing is, right now, markets are pricing in perfection. All eyes on the U.S. election, for instance, right, at this point in time, and there are risks to that. How might the currencies in Asia be impacted if there is a surprise, whatever that surprise might be?
I don't think we know what the surprise is, right? Because the election are just so close, and it's too close to call at this point. We don't even know. I think the biggest risk for the market is a clean sweep, right, from either party, because then you can obviously see a lot of these big fiscal packages being implemented and will likely be implemented as a result. But obviously, with a Trump win, I think the concerns come up, especially for the region, with his talk of tariffs. And obviously, we saw the implications before, back in 2018, when he was talking about it, and we saw how much it weighed on this region, not only on the CNY, but other currencies as well. So that kind of tariff talk, that tariff tough talk, is not a good thing for this region.
And the risk is actually on the Chinese currency, right? I mean, or other currencies in the crosshairs of U.S.-China tensions.
But as Mary has already mentioned, it's just too close for the market to react to any of the headlines. So, like just yesterday, we've heard that Trump would like to do some kind of free trade zones wherever in the federal land. But then, like, market is not reacting to it because the elections are just too close to call. There's no way that you can actually predict what will be a surprise and what will not be a surprise. In which case, you can only start to react to that in December. You know, from now until December, you're still going to have the Fed cutting. And our view is that the Fed will cut 50 basis points. So overall, it's very difficult to go long on the dollar just on the possibility that there would be tariffs, because that's going to be a conversation for next year.
Just one final question before we let you go. Top trade for the rest of the year would be?
Aussie Kiwi.
There you have it. Quite clear. Aussie Kiwi Eugenia Victorino of SEB and Bloomberg MLive strategist Mary Nicola. Thank you so much for your insights today. Now, still ahead this hour, we'll take a closer look at growing corporate ties between Europe and Southeast Asia with the EU-ASEAN Business Council as global tensions upend supply chains and trade. But first, Iran's president with a harsh warning at the United Nations over Israel's attacks in Lebanon. An update on Middle East tensions next. Keep it here with us. This is Bloomberg.
Full-scale war is not in anyone's interest. Even if the situation has escalated, a diplomatic solution is still possible. In fact, it remains the only path to lasting security to allow the residents from both countries to return to their homes and their borders safely.
We condemn Israeli crimes against humanity. It is imperative that the international community should immediately stop the violence and bring about a permanent ceasefire in Gaza and bring an end to the desperate barbarism of Israel in Lebanon before it engulfs the region and the world.
And that was President Biden and Iranian President Masoud Pezeshkian addressing the UN General Assembly on the escalating conflicts in the Middle East. Now, we have breaking news right here with the U.S. probing tech firms SAP, Carahsoft for potential price fixing. German software developer SAP, product reseller Carahsoft, and other companies are being probed by U.S. officials for potentially conspiring to overcharge government agencies over the course of a decade. The DOJ investigating billions in purchase from SAP over a decade. Other companies under scrutiny in this Civil False Claims Act. Again, the U.S. probing tech firms SAP, Carahsoft for potential price fixing, and we'll bring you details later on. Now, keeping to Iran, Iran's president also says plans are underway to discuss a stalled nuclear deal after a positive meeting with France's Emmanuel Macron. Let's discuss this with our senior editor, Bill Ferris. And Bill, what do we know about these discussions?
Well, we're still trying to find out more about who exactly would be involved, whether Iran has some kind of a new proposal here. When you look at the list of nations who are involved in that nuclear deal, it's the U.S., Russia, China, France, Germany, and the UK. It's stating the obvious at one level, but those are not countries that tend to get together in a group anymore, given some of the geopolitical events. So it's hard to see a group meeting to talk about the Iran deal. But it does show the importance to Iran, I think, of trying to find a way to get some of these Western-led sanctions off their economy. Pezeshkian is a new president. He wants to show that he can generate some growth. But on the other hand, he also brought this message of criticism for Israel and rejecting accusations that his nation is supporting Russia's war in Ukraine. So it's a very mixed message to bring to the UN at this time. I'm not sure that it's going to generate a lot of momentum that he's looking for on the economy.
We also heard from the U.S. President Joe Biden speaking for the last time at the UN General Assembly. What were some of the key takeaways?
Well, it is. You're right. After about 50 years of public service, this was Joe Biden's last time at the UN podium. He talked a lot about the things that are very important to him in foreign policy, particularly the system of alliances. I think when he looks back on his own foreign policy policies as president, building that alliance against Russia's invasion of Ukraine is probably something that's going to be on the top of the list. That said, it's not clear where things will go once he leaves office in January. The Russia-Ukraine war is still going on. The Mideast is in flames as well. So it's not clear whether that alliance system is strong enough to bring closure to some of these conflicts.
That's right. All this happening against a backdrop of the attacks in Lebanon, for instance. I mean, what's the latest there? What do we know?
Well, Israel continues to say that it is going to be pushing back Hezbollah forces from the southern part of Lebanon. It wants to see the 60,000, 70,000 Israelis who have had to evacuate northern Israel be allowed to return to their homes. It's not clear that there would be a full-scale invasion of southern Lebanon, but short of that, Israel does seem to be committed to pushing back Hezbollah's militants so that they provoke less of a threat to Israel.
Bill, thank you so much for that. Bloomberg's Bill Ferris. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Let's take a look at how treasuries are shaping up. We know that two-year yields are headed to their lowest level this year. That's on the prospects of further rate cuts by the Fed. Also, bear in mind, a gauge of consumer confidence slumped, and that's adding to the case of another half-point interest rate cut by the Fed possibly next month. Two-year yields, of course, headed for the lowest level this year. Now, IMF Managing Director Haslinda Amin told Bloomberg that the U.S. is in a good place when it comes to inflation, but warns that slow growth and high debt is something to worry about.
Two very important points for your audience. Number one, yes, growth is holding, but by historic standards, it is not high enough to retain good prospects for our economies. Before the pandemic, average growth 3.8%. Two, we also have very high debt levels. And that combination of slow growth and high debt is something that we at the fund worry about. What we want to see is countries taking seriously the importance of fiscal prudence. So the central banks have done their job. They fought inflation. Inflation is going down. Rates are going down. We need the fiscal side to be equally committed. And of course, we want to see more attention as to what drives growth up.
I want to go back to inflation, though. With the Fed finally making that big move last week, that half-a-point cut, inflation defeated, mission accomplished, done? Or would you say not necessarily yet?
Watch it. Yes, we are in a very good place. We have been predicting soft landing. We would see inflation down and growth still remaining firmly in positive territory. This is where we are.
Right.
We know that in the services, inflation is still flaring a little bit more, so the Fed is going to watch it. But broadly, we think that the Fed got it right, and we would see how that evolves in the next meeting of the Fed. Not to exclude there could be more cuts. But again, why is the Fed successful? Because it is data-driven. So they would watch incoming data very carefully.
And that was IMF Managing Director Haslinda Amin speaking to Bloomberg's Carol Massa. Let's do a check on property stocks in China on the back of the slew of measures to prop up not just the economy but also the property sector. The PBOC will be cutting outstanding mortgage rates for individual borrowers by an average of 0.5 percentage point. That was announced yesterday. The minimum down payment ratio on second home purchases will be lowered to 15% from 25%. We're seeing reaction in the markets for a second day. Take a look where we are in terms of property plays. China Vanke up by more than 3%. Sunac China surging by about 6%. We're also taking a look at liquor stocks, by the way. Sources are telling us that Hong Kong will be cutting taxes on spirits. Hong Kong spirit tax reduction may be part of the Hong Kong CEO's policy address. Kway Chou Mau Tai up by 2.5%. Wu Liang Yi currently up by about 2.8%. Again, Hong Kong spirit tax reduction may be part of the Hong Kong CEO's policy address. Up next, EU-ASEAN Business Council Executive Director will be joining us. Keep it here with us. This is Bloomberg.
Chinese markets have gone through a long period of underperformance, almost to a stage where people just don't want to be there. And I think what these moves are saying is that probably we've reached the end of that underperformance.
I think the things that we would need to see to fundamentally alter the trajectory are, the ingredients to this would include reforms that ultimately push the savings rate down and drive structurally higher demand from the household sector.
I think they need to take more decisive measures and significantly larger scale funding to help stabilize the property market.
It signals a change of the policy stance. It went from a highly reluctant stance to stimulate the economy or showing such a high degree of tolerance for slower growth over the last 2 years towards one that's much more proactive.
How effective it is, it probably would take some time to see, but then versus some of the stimulus kind of policy that they have announced so far, it's been a more better coordinated one.
Some of our guests on Beijing's stimulus barrage. And speaking of China, Chinese markets just heading to lunch. Let's take stock of where they are at this point in time, continuing to gain for a second day. And Hong Kong and China rallying further as the PBOC cut one-year MLF to 2% from 2.3%. That's on top of the measures which we saw yesterday, attempts to prop up not just the economy but also the property sector. CSI 300 index up 2%, Shanghai Com up by 1.8%. In terms of the Chinese yuan, this is how it's looking. 701.71 versus the USD. Remember, just not too long ago, earlier this morning, the yuan breached the 7th psychological level for the first time since 2023. Offshore yuan, by the way, extending a rebound of some about 4% from the lows in July this year. So, despite the excitement on the equity markets, economists are striking a cautious tone, saying it might not be enough to pull the $18 trillion economy out of a protracted slump. For more, let's bring in our economics correspondent, Katia Dimitrieva in Hong Kong. Katia, this appears to be, on the surface, quite a bit of stimulus, but how much will it really help the economy?
Yes, that's the big question. It represents more than $1 trillion in stimulus, but it only helps when you pump money into the economy if people actually spend it and companies actually start making more money. And when you think about the three main issues that China has really faced in the past few years, it's been really three, right? We have consumer sentiment and the real estate market, we have deflation, and we have the real estate sector. So the announcements that were made this week, including the additional bringing down in the rate today that we heard from officials, it does help these things on the margin. But it doesn't even address the deflation issue, which officials didn't even talk about in the press conference this week. So when you have an economy that is so highly leveraged to the real estate sector, 70% of household wealth is tied up there, 90% of households actually own their properties, and you've had such a big decline in the property sector, you really need to boost their sentiment in order to get them to spend. It's not clear that this package actually does that, which is why perhaps we saw that immediate pop in the stock market and then kind of a bit more normalization after that. They tend to be quite sentiment driven. So it's not really a structural change, and a structural change is what economists have been saying all year is necessary, including just a lot more money. More than $1 trillion is pretty big, but reading economists' notes all over the past 2 years, it seems like a lot more would be needed to both give cash to people directly potentially, or a bigger rescue of the property sector,
right,
which is, we know, something that China doesn't want to do.
Pretty big, but not big enough. And time again, we hear economists saying, we hear market participants saying, we want more. Is more coming?
A little bit. The good news is that there is some fiscal firepower left. There is some long-term government bonds. There's also this cash for clunkers program, which is when people can trade in sort of their household goods, which so far hasn't been a part of, I hesitate to even say bazooka-style stimulus that we were expecting, but it is something. And there's also, on the monetary policy side, officials did say that there potentially could be more rate cuts coming, and they're really helped with that by the U.S. So we had the Federal Reserve cutting last week by more than anticipated. That's going to create a lot more room for China and other economies to start lowering their rates more on a wide range of products, but especially their policy rates. That'll make things cheaper, maybe incentivize consumers to buy a second house, maybe incentivize some consumers to get back into the housing market in China. There are certain things that are on the way, so definitely not the end of what was announced this week.
All right, wait and see. Our economics correspondent, Katia Dimitrieva in Hong Kong, thank you so much for your insights today. Now, as pressure grows on Western companies to reduce reliance on China, investors are asking whether emerging economies in Southeast Asia can provide an alternative. Let's discuss this and more with Chris Humphrey, Executive Director of the EU-ASEAN Business Council. Chris, good to have you with us. We often hear that Southeast Asia, ASEAN economies benefit from a China plus one strategy. How are European companies looking at this? Where are the opportunities?
That's a very good question. Good morning to you, Haslinda. I think we're seeing now more and more of a move, of course, towards de-risking of supply chains. One thing we learned from the pandemic in particular, one thing we also learned from the invasion of Ukraine by Russia, is that companies need to make sure their supply chains are more diverse. They're not just sourcing from one particular area. I think current geopolitical tensions highlight the need for that even more, and Southeast Asia is clearly well positioned to take advantage of it. The countries of Southeast Asia tread a very fine geopolitical line between the West and China and others. They have the right geographical location. They have the right moves in terms of their own economic integration. They have pretty good connectivity to the West and to the East as well. And then they have a great workforce in the region as well. And that makes it very attractive, particularly for European businesses who are looking to extend their China plus one strategy.
The thing is, Chris, as much as we talk about ASEAN benefiting from shifts in supply chain, some supply chains within ASEAN are inefficient themselves.
Yes, I'm afraid that is true. We recently did a business sentiment survey, and I'm afraid in that there was a very high number of respondents saying that supply chains within the region were inefficient. Only 2%, for instance, said that customs procedures were speedy and efficient. So there are things that need to be done. Now, to be fair to ASEAN, they are making the right moves. They're working on an upgrade of their own internal free trade agreement, the ASEAN Trading Goods Agreement. We have high hopes that will make advances. The customs authorities are moving more and more towards paperless trade and faster clearances. So there is an upside. Things are getting better, but there is still some way to go. So if you're looking at using regional value chains within ASEAN to feed into your broader global supply chains, yes, there are some things that need to be improved, but we're heading in the right direction.
Where are European companies looking to invest in ASEAN? It is a region of 10 nations. Which countries in particular?
Well, in recent years, Vietnam has clearly been the darling of European industry, and that's on the back of their FTA with Europe, but also that Vietnam themselves are involved in a number of other FTAs, including CPTPP and RCEP. And that makes Vietnam very attractive for investments. I think looking ahead into the near and medium term, assuming the FTA discussions with Thailand and the Philippines go well, you'll see a lot more investment switching to those. Malaysia is clearly making itself advantageous for investments, particularly in the semiconductor sector and the automotive sector. So I think you're going to see more of a spread going forward.
It is interesting that you missed out mentioning Indonesia, which is the largest country in Southeast Asia, a nation of 270 million people. But this is also an economy that's been settled by protectionist policies. How are you looking at the opportunities in Indonesia?
Well, we're watching perhaps the end game of a negotiation between Brussels and Jakarta on a free trade agreement at the moment. I'm afraid after almost 9 years negotiations, we're not feeling too hopeful about that. And that is because there are some major issues on both sides that need to be resolved. On the Indonesian side, concerns for European businesses are around local content requirements and on automatic import licenses. And that makes it difficult when you're being asked to make major investments in the country. If you can't secure the supplies for your manufacturing facility in the local market, you're automatically at a disadvantage. And if you can't be certain that the import license will be granted in time, that obviously impacts your ability to do business there as well. For the Indonesians, of course, they have a number of concerns with the EU Green Deal, which they want to try and resolve.
We started the conversation talking about how the EU is trying to reduce its reliance on China. Show us, in terms of numbers, the kind of commitment European companies are willing to make.
Well, our FDI to ASEAN has been pretty steady over the last few years. Last year, it was shy of $30 billion that made Europe the second largest source of FDI to ASEAN. And I think that shows you the commitment. We've been regularly in the top 3 over the last decade. And since the end of the pandemic, in fact, investments from Europe into Southeast Asia have been around $100 billion US. So the numbers aren't small. European companies are looking to make major investments. The trade numbers remain solid. They're over $300 billion US per year, making Europe, I think, the second largest trading partner of ASEAN. So we have great faith in the region. We are making those investments. We are delivering on those investments. They're not just announcements that never happen.
Before we let you go, Chris, we're keeping a close watch on the U.S. elections. In the context of U.S.-China relations, we know that on the back of shifting supply chains, we've seen some even Chinese companies moving their factories to Malaysia, for instance. I'm wondering how you're assessing the risks in investing in countries in Southeast Asia with ties to China.
Well, all of Southeast Asia has ties to China. China is their largest trading partner after all, and it's the 800-pound gorilla on their doorstep at the same time. So you can't ignore that. I'm afraid it doesn't matter who wins in the White House. I think you're still in for a difficult time on US-China trade relations. It will impact Southeast Asia. But I think you'll see more and more Chinese companies looking to, again, de-risk themselves, if you like, and diversify where they're operating from. And Southeast Asia looks very attractive for them to do that.
Chris, thank you for your insights today. Chris Humphrey, the EU-ASEAN Business Council. Coming up, we'll get an exclusive update from Carlyle about the private equity boom in India. Find out which sectors they're looking to invest in. This is Bloomberg.
Asia is an under-penetrated market for private equity, but it's expanding rapidly. India, we've been talking about, was maybe a $2 billion buyout market 10 years ago. This year, it was a $10 billion buyout market. In 4 or 5 years' time, we think it's going to be a $40 or $50 billion buyout market.
EQT Group Asia Chairman Jean-Eric Salata speaking exclusively with us about India's private equity potential. Now, one of the longest-standing investors in India's private equity sector is Carlyle. They've made deals worth more than $6.7 billion over the past 20 years. I asked their India head, Amit Jain, about their latest strategy.
Well, we've always been, in India, we invest into two mega themes, what we call as India for India and India for the world. India for India is primarily play on rising middle class. As India moves from $2,300 per capita to $3,000, we're seeing Indian wants to consume more. Just before me, one of the speakers was talking about the luxury sales of watches on your show, and we are starting to see that happen. Healthcare is moving towards more proactive than reactive. We're seeing financial services move from mortgages to wealth management. So I think that's a big theme. We continue to be very bullish on the domestic side. What is starting to become very attractive is India for the world on the export manufacturing side. I truly think if India has a shot at becoming the factory to the world, I think this is the place to be. You've got infrastructure building up. Geopolitically, we find ourselves in a politically, kind of favorable place. And therefore, if we could build factories around specialty chemical, packaging, auto components, I think India could really do well in that sector in the time to come.
So how have you deployed your funds differently? I mean, what have you been doing the last 12 months?
So in the last 12 months, and I'd probably give a little bit more because ours is a bulky business. We're a deal-by-deal micro-investor. If you look at last 5 years, we have invested more capital than the first 13 years. So we've been in India for last 18 years, and I think it just tells you how leaning forward a view we hold in India. And in the last 5 years, we've gone ahead, bought a bank. We own 10% in Yes Bank. We bought India's largest integrated skincare and a beauty business, a company called VLCC, which is our play on the domestic side. 4 years back, we bought the largest IT services company deal done called Hexaware, which we just filed for a prospectus for IPO. So it's been, again, mix on India for India, India for the world. Roughly 50-50 would have been our deployment on those two themes.
How do you see the pipeline for IPOs in India? You've seen about 6 companies through to IPO, and some say that India is just one of the few markets which are actually seeing IPOs.
I would say it's probably the #1 market in terms of getting, liquidity from IPO and capital market events in the world today, right? And it's evident in the fact that we've taken 6 companies public, we've filed for the 7th one, and there's more to come. I think the pipeline is strong, and it kind of links back to the point that there is domestic liquidity. India in this year has got $38 billion US of inflows from domestic savers. This is money coming in each month through a product called Systematic Investment Plan. Each month, take a guess between $2 to $3 billion, and you see this money trying to participate in capital markets in India.
You know, when there's so much optimism, there should be caution as well. If there's one risk in India, what would that be?
I think, Indians are pretty emotional, I would say, and we require...
In what sense, Amit?
In many ways. I think we could go very happy and we can get very sad. And I think what is required fundamentally is a mindset of equanimity, where we can put our head down each day, get stuff done. So I really worry that the quality of execution should not come in the way of the scale of the promise India holds.
Credit fund. Is there any plan for a credit fund in India, or are you considering tapping, for instance, your global credit funds out there to fund your deals in India?
I think the Indian markets are maturing from asset classes standpoint. We started 18 years back. We've really built a very strong presence in the core private equity franchise we hold in India. And I think we keep evaluating what other asset classes should we enter, real estate, asset-backed financing, and credit being one of them.
And that was Carlyle India Advisors MD and head Amit Jain. India's been trading about 3 minutes now. Let's do a check on how they're doing. Of course, this is on the back of 2 days of losses. It seems that those losses are extending today. Sensex, Nifty in negative territory, just barely though. This is an overstretched market when it comes to valuations. Of course, there have been warnings about a correction mounting. Stock valuations overstretched after both the Nifty and the Sensex hit record highs. So beware. Yes, there is potential. Yes, there is growth. Yes, there is liquidity, but valuations are overstretched. And HSBC is coming out to say that perhaps when it comes to the survey they've done in India, it's suggesting that economic activity, or its PMI in India, slowed in September to the slowest pace this year. So perhaps a time to take money off the table. This is a $5 trillion equity market. It is facing some challenges, it seems. Stock prices, yes, keep climbing, but there are, in terms of our buy rating, there's some downside to that as well. We're seeing analysts having a hard time recommending stocks worth buying in India's stock market. Data analyzed by Bloomberg show that as of Tuesday, the number of stocks on the Nifty 200 index with a consensus buy rating total 61. That's the lowest level in at least a decade. A dimmer outlook for corporate earnings is making analysts skeptical of further gains in some stocks that have helped drive a 9-year rally. Well, still ahead, Caroline Ellison gets a 2-year prison sentence for her role in the collapse of FTX, despite turning prosecution witness against Sam Bankman-Fried. We have details next. Keep it here with us. This is Bloomberg. Asia getting a boost from the slew of stimulus measures out of China pretty much. The Nikkei 225 back from a holiday yesterday, pretty flat right now. The thing with the Nikkei is that it is under pressure from a strengthening currency. The yen is the currency we're talking about. Some say the yen, though, faces headwinds. If you take a longer-term view, the underlying trend for the yen is, in fact, a selling trend. Capital outflows, real yields also positioning will weigh on that currency. Year to date, the yen is up 12% so far. That's been pressurizing exporters in particular. In terms of the MSCI Asia Pac Index, it is a positive story. It is up by 1.3%. Let's take a look at how we are shaping up in terms of cryptocurrencies. We have the Bitcoin currently edging higher by 0.3%. Ether, Solana, though, in the negative. Staying with crypto, former crypto executive Caroline Ellison has been sentenced to 2 years in prison for her role in the collapse of digital assets exchange FTX. Let's get more with our tech reporter Annabelle Drulis in Hong Kong. So, Belle, jail time for Ellison despite her flipping to testify against her former boss and former boyfriend, Sam Bankman-Fried.
Yeah, that's right, Hassan, and we can get more on that level of cooperation in just a moment. But the headlines here, as you said, Caroline Ellison is going to be going to jail for 24 months for her role in the collapse of FTX, 3 years of probation as well to follow that. She's someone who, as you mentioned, was very close to Sam Bankman-Fried. Not only was he her former boss, because Ellison was the head of the hedge fund Alameda Research that misused the FTX funds. Sam Bankman-Fried is also Caroline Ellison's former boyfriend. Now, her surrender date is set for about 6 weeks from now, on or after November 7, and she's also been ordered to forfeit $11 billion. That's not to say that Ellison has $11 billion in her bank account, but it is the amount that was lost in the FTX fraud, and so she is going to need to give up some assets. This happened at a court in New York overnight, and our Bloomberg colleagues who were present say that Ellison didn't really show that much emotion as the verdict was read out. Her mum, her sister, they were there to support her. We do understand that they teared up. They were seen wiping their eyes with tissues, for instance. But Ellison barely reacted. Just continued to look down at the floor, though she did speak with victims of the FTX fallout later in the courtroom and briefly apologised to them, saying there's not a day that goes by where she doesn't think about what she did.
Belle, interesting to point out that the judge really praised Ellison profusely, but prosecutors did tell the judge that Caroline Ellison deserved leniency as well.
Yeah, well, it goes back to that level of cooperation, because the U.S. District Judge Lewis Kaplan, to your point, said he'd never, ever seen that level of cooperation before. Caroline Ellison was certainly a star witness, as we said, in the conviction of Sam Bankman-Fried, and apparently she met with prosecutors something like 20 times in the effort to help them build the trial. So she gave very full, thorough details. She even directed authorities to crimes that they didn't know about themselves. In exchange for that level of assistance, yes, there was the expectation there would be some level of leniency. So Caroline Ellison's legal team, for instance, actually sought for no time to be served in prison. US probation officials also said that she should serve 3 years of supervised release, no incarceration. But the judge in this case said that essentially jail time was needed as a deterrent. So again, perhaps no thing as a get-out-of-jail-free card has in this case.
That's right. Annabelle Drillers, great reporting. Thank you so much for that. Let's do a quick check on gold in particular, reaching a record highs as U.S. data supports deeper rate cuts. There you have it, gold at 2660.94 right now. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.